Hello everyone and welcome back to Finance with JCL, the show aimed at new and intermediate level investors. So the specific objectives will be look at those key fundamentals. I will then decide from my own point of view if it's a suitably strong company for a long-term investment, and then I'll use the information to calculate the margin of safety in the buy price based on the free cash flow generation of the business, and that will lead me to the decision of whether I'm going to buy it now. What I would suggest is that you don't just go out and blindly copy buy or not buy decision. Perhaps look at the information and compare that to how you value companies and see whether there are bits you can take for your methods of valuation, but you should make your own decisions around what you buy and sell, what you're comfortable holding, and perhaps even take professional advice where you need to. So we start off with the mandatory metrics. So for me, I have a series of key tests that a company absolutely must meet in order for me to even consider looking at it in more detail and to invest. If any of these are failed, the likely outcome of that will be not an investment. So first of all, a business should have a positive free cash flow, and in this case, Roche does. Secondly, the net income should at least be stable, but ideally growing, and again, company passes this test. The current ratio should be above 1, so that means in the short term, sort of at a 12-month period, the company should be able to pay its bills, 1.23, so slightly above the threshold, but that's fine. The return on equity for the company should be above 8%. And the return on equity is a measure of how well the company uses its money to generate future returns. Now in this case it's quite substantial, so it's a 43.5% for the most recent financial period, and the average over the last 10 years is 58%, so this is well above the 8% threshold minimum that I set. Fifth measure is the debt to equity figure should be below 2, and it's 0.4, so that's well below. The interest coverage should be above 6, which it is, and the net income should be positive, and that is. So I suppose the final question is thinking about the sector, so kind of the medical sector. They're registered in Switzerland. It's a company that's been around for over 100 years. Very good results. Would I sort of be comfortable on the first view holding this company for over 10 years, taking into account these various factors? Is the market likely to be at least the same size or bigger? Or, to me, it feels like I absolutely would. So that's my assessment, that's some of my criteria. Now those are the mandatory metrics which fulfills. That means I can now look at the desirable figures. So the figures in some of those categories before were the minimums, but now let's see if it's not just a passable company, but a really excellent company. So is the net income above 20%? Now in the last financial period it's 21.5%, and the average of the last 10 years has been very stable at 19.9%. So for all intents and purposes, that net income is significant over a long period of time. So the company is profitable, so that's some protection there in case of changing costs or incomes in the future. Now the return on equity minimum was 8%, ideally I'd have it above 20%, and it's well in excess of that, so 43.5% most recent financial period, 58% average over 10 years, so that is absolutely fantastic. So this company is very good at using, when it invests in itself, using its own money to generate future returns. And the return on assets is sort of a similar measure, and ideally that's about 10% where it's looked at, and 16.1% here, so that's good. So a company generates operating cash flow and it must pay its capex, capital expenditure requirements before you get to free cash flow. And what we do want to see is a company that doesn't spend most of its operating cash flow generated on capex, because that does leave very little free cash flow effectively for the shareholders. And in the case of this company, the capex requirements are a low proportion of the cash flow generated, so that's absolutely fine. Now that current ratio ideally would be above 2 if it was a perfect company. It's 1.23, so it doesn't meet that particular metric. debt to equity, ideally, it needs to be minimum below 2, but for perfect companies below 0.5. 0.4 here, so that's fantastic. And the final test, does it have some kind of moat? Is it a company to think of? Is it a well-known company? Does it have sort of a long-term history? And for Roche, it absolutely is. So the summary here is it passes all of the mandatory thresholds, and most of the desirable metrics are also met or exceeded, some by particularly large margins. So it's looking good so far. But what I like to do is not just look at those figures in isolation, I like to look at the 10-year view. So the next couple of screens we'll look at from the Morningstar website as the source. I've just taken some screen grabs there, and I've hidden some of the rows which I feel are less important, so we can concentrate on the key data. And the information goes from 2010 to the most recent financial period. So we get this 10-year view and trend. So I like to look at the net margin, and that net margin is hovering around about sort of 18 to 21% in that kind of region. So it's a very good net margin. The return on assets is pretty stable, it's always above 10%, so that's good. And the return on equity, although it has decreased from perhaps what it was in 2010, where it was 103%, 2011, 87%, since 2014 it's always been in that 30 to 40% region. So that's sort of been a bit more consistent, and it's a very big, strong number. Return on invested capital is pretty consistent, pretty much always above 20%, and the interest coverage in the most recent period is almost 26. So they're able to cover those interest payments very strongly, and that metric has improved since 2010. So from a profitability perspective, this is looking like a very strong company. Now, from the liquidity and financial health view, the current ratio used to be a little bit higher, and it's dropped a little bit recently, but it is still above 1. And the debt to equity has reduced considerably from 2.94 in 2010, dropped down, it's now 0.4, which is the lowest figure that it's been in the last 10 years. So this company doesn't carry huge amounts of debt, so it's got some leeway there in case things do get a bit choppy going forward. And then I'd like to have a look at the kind of key ratios and information here. So revenue 47 billion to 60 or so billion, increasing gradually each year. So that's looking pretty nice. Gross margin very consistent, hovering around that 70% number. The operating income again pretty consistent. 13, 14 billion most years. Let's actually increase to over 17 billion for 2019. And that operating margin's always been between kind of 25 to 35%. So it's a very healthy margin. And therefore that kind of net income, you're looking at 8 billion 2010, you're getting up to retail increases around about 13 billion for the last period. So that's been growing. And the earnings per share started off around 10 in 2010, I think the Swiss francs, and we're now looking at sort of 15 regions, so that's ticked up. The dividends increased every year from 6 to 8.7 in 2019, so that is good, a consistent and increasing payout. Although of course that is a bit of a converse statement, because if a company is very good at reinvesting money into itself, you always don't want them to pay too big a dividend. So we do look at the payout ratio, which is the next line down. So how much that they could pay out, are they actually paying out? So that's fluctuated quite a bit, 50, 60, 77% in 2015. So perhaps it's a little higher than I'd like it to be. That's that payout ratio. Now we also look at the shares, the number of shares, because it could be that the company's performed share buybacks. We'd have to take that into consideration, look at the earnings per share. And the number of shares in issue has been very, very consistent, around about 860 million. So there's been no share buybacks. It's all been pretty consistent, so nice and clear. The book value per share has been increasing at a very high rate, from 18.5 in 2013, we're up to 40 now. So there's growth in the value of the company. And then also importantly, from the valuation perspective, we talked about cash flow. So that operating cash flow, sort of 14, 15 billion 10 years ago, it's creeping above 20 now. And the capex spending is quite a low proportion of that, usually less than a quarter, certainly less than a third in most years. So that's quite a low proportion. So your free cash flow is always at least 10 billion per year generated, which is effectively what the shareholder might be entitled to if they own the whole company. So that is good to see. And there's your free cash flow per share. I don't look at that too much, but it's good just to cast one's eye over it, see if there's anything surprising there. And then the working capital is always positive. So my assessment of this company, thanks to the information of Morningstar, is that the key and desirable metrics are all very good, and the 10-year view shows to me nothing alarming, and it all looks very consistent. It's all kind of ticking up year by year, so it looks like an excellent company to me. So subject to the review of the price and whether I've got sufficient margin of safety, I want to invest in this company. So I guess to reiterate that, it does pass. Now ideally I want a 10% rate of return, or of course higher, but the absolute minimum baseline I would take at the moment is 6.66%, which is probably 6% above the sort of long-term 10-year US Treasury bond. So that minimum rate of return may increase in the future as potentially interest rates increase, although I can't see that happening for a couple of years yet. So the free cash flow analysis, I've run the numbers based on discounting the cash business to generate in the future by 10%, because I want a 10% return. Get a value of 339 for the company. The buy price, therefore, with a 50% margin of safety to buy the share on a discount, and also to give me a margin for error in case I've calculated things incorrectly, I would be buying at 170. However, the actual price is 320, so there's actually only a 6% margin of safety between market price of 320 and intrinsic value of 339. So that's not very good. So actually I'm not going to buy based on that 10% return, so I'm not going to get my desired return. However, can I get my base return of 6.66%, which links to my £1 million challenge? So the intrinsic value that I've calculated there, which is predicting the cash the business will generate in the future, discounting that future cash flow by 6.66% each year, and that gives an intrinsic value of the business at 602 Swiss francs. So therefore my buy price will be 301, the 50% margin of safety, but the market price is 320, so that's a 47% margin of safety. It's almost there. It's pretty borderline. Should I buy it? I guess probably not, because if that's my base return, it doesn't quite hit that 50% threshold. If I want to be strict and disciplined, I shouldn't buy this organisation's shares yet. But it's pretty close, so I'll keep an eye on it. So therefore, the next action for me is it best than some of my existing portfolio? Yes. This company is stronger than several of the stocks in my existing portfolio. And the stocks I've got in the portfolio, actually, I'm probably starting to get to the point where I'm getting to a limit of how many I want. So what I may end up doing is when the price for this stock gets to the right level, I would probably actually sell some of the weak companies and put more money into this one. It's a higher quality stock. So as I mentioned, I'm not going to buy it yet, just because that 50% margin of safety isn't met, but I absolutely add it to my wish list of stocks that I'm going to buy at certain prices, and I will therefore set up an alert with my brokerage so that when it does meet that price, I can get involved straight away. And in fact, I might put an order in. I think what I can put in an order which sets up, once the price hits X, purchase Y amount. So I'll set that up and I can leave that open for a period of days. So those are the actions that I'm going to take, but please do think about what you've seen, but make your own assessments, because everyone, even with the same information, comes up with different answers to what is the future cash flow of the business. So I've used my own personal calculation for that, but you may come up with a different number. So be interested to see how you calculate the value, and if you have had a go at it and you've got a value for this company, drop me a comment in the box below. I'll be really interested to hear about it. So thanks very much for joining me on the show today. So thank you very much, and I will see you next time.